U.S.-Iran conflict. Impact on the Indian stock market and global economy. The escalating tensions and recent military actions between the U.S. and Iran have sent shockwaves not only through global politics, but also across the stock markets. From India's perspective, this situation is highly sensitive because our economy is heavily dependent on oil imports and global trade routes. Overall impact on the Indian stock market negative. Historically, war brings uncertainty, and the stock market thrives on stability. In the event of a U.S.-Iran war, we could witness short-term panic selling and a bearish trend in the Indian markets. Foreign institutional investors, FIIs, tend to pull capital out of emerging markets like India and shift toward safe haven assets like gold or the U.S. dollar. The crude oil crisis. India imports nearly 85 to 90% of its oil requirements. If tensions in the Gulf region escalate, oil prices could surge past $90 to $100 per barrel. This would widen India's current account deficit, CAD, weaken the rupee, and hike domestic petrol and diesel prices, creating a negative ripple effect across the entire economy. Sector winners. Defense and oil explorers. Defense companies typically benefit during wartime as global demand for weaponry and technology rises. Asterisk defense. Companies like HAL, Hindustan Aeronautics, Mazagon Dock, and Bar Electronics BL may see significantly strengthened order books. Asterisk oil producers. ONGC and Oil India stand to gain as rising crude prices improve their profit realizations. Sector losers. Aviation, paints, and OMCs. While oil producers gain, companies that consume oil as a primary resource face heavy losses. Asterisk aviation. Airlines like Interglobe Aviation Indigo will see a massive spike in fuel expenses ATF. Asterisk paints. Companies like Asian Paints and Burger Paints rely on crude derivatives for raw materials, which will squeeze their profit margins. Asterisk tires and chemicals. Rising oil prices significantly increase the input costs of these industries. Gold as a safe haven. During global conflicts, investors flee the stock market in favor of gold. This results in a sharp rally in gold prices. In India, gold rates could hit new record highs, potentially toward 170,000 Indian rupees per 10 grams. Companies like Muthoot Finance and Manappuram Finance may benefit from the increased value of their gold loan portfolios. Impact on silver. Silver often follows gold's lead, but it is also an industrial metal. Prices will initially rise due to safe haven demand. A prolonged war that slows global manufacturing could lead to higher volatility in silver compared to gold. Logistics and supply chain, Strait of Hormuz. Approximately 20% of the world's oil passes through the Strait of Hormuz, where Iran holds significant influence. If this route is disrupted, freight rates and insurance premiums will skyrocket. This would negatively impact Indian exporters and the operations of companies like Adani Ports. IT sector, a mixed bag. Indian IT giants like TCS, Infosys, and HCL Tech derive a majority of their revenue from the U.S. and Europe. If the war triggers a recessionary fear in the U.S., new contracts may be delayed. However, a stronger U.S. dollar provides a slight cushion through favorable currency conversion, inflation, and the RBI stance. Expensive oil directly leads to higher inflation in India. Under these circumstances, the RBI, Reserve Bank of India, may be unable to cut interest rates. This puts pressure on rate-sensitive sectors like banking and real estate, leading to potential stagnation in stocks like HDFC Bank, ICICI Bank, and DLF. Strategy for investors. Experts advise against panic selling your entire portfolio during such times. Market dips caused by war are often a buying opportunity for the long term. Investors should consider gradually increasing their exposure to the defense sector